Welcome, and thank you for taking a few minutes to watch this presentation. I'm Gordon Brown, Insurance Advisor with Green Wealth Management Group in Southbury, Connecticut. Today, we're going to discuss a life insurance planning concept known as laddering, a strategy designed to help align insurance coverage with real financial responsibilities throughout different stages of life. We'll cover the difference between term and permanent insurance, the concept of human life value, and how a laddered approach may help families protect what matters most while adapting as financial goals evolve over time. Life insurance planning shouldn't be static. As our financial lives evolve, our insurance needs often evolve as well. And unlike many financial products, life insurance isn't really about you, it's about the people who depend on you. Before discussing laddering, it's important to understand the two primary categories of life insurance. Term insurance provides coverage for a specific period of time and is often used as temporary financial obligations like income replacement, mortgage protection, or supporting young children. A simple way to think about term insurance is like renting an apartment. You're paying for protection during the years you need it, but there's typically no long-term value associated with this type of policy. Permanent insurance, on the other hand, is designed to last for life and includes cash value component that can grow over time. In many ways, it's more comparable to owning a home, where part of what you contribute may build long-term value within the policy. Now, permanent insurance is often used for estate planning, legacy objectives, business planning, or long-term liquidity needs. Now, neither strategy is inherently better, they simply serve different objectives within a financial plan. In many cases, families may ultimately use a combination of both. One of the foundational concepts in life insurance planning is something called the human life value. Human life value attempts to estimate the economic value of a person's future earning potential and financial contribution to their family. And the reason I say attempts to estimate is that you and I both know that our lives are priceless to our families. However, what most families don't realize is their largest asset may never appear on a balance sheet. So to give you an example, a 35-year-old today earning $250,000 per year, with 25 working years remaining, they may generate over $6 million of future income over their career. That future earning potential is often a family's largest financial asset, and protecting it becomes critically important if others depend on that income. While income protection may be extremely important today, many financial obligations are temporary. Children eventually become financially independent, mortgages get paid down, college savings goals are completed, and retirement assets begin to grow. In a sense, life has seasons, and financial obligations change throughout those seasons. The financial pressures that feel overwhelming today may look very different 20 years from now. And that creates an important planning question. Should insurance coverage remain exactly the same for your entire working life? One of the most common planning issues is that insurance coverage often stays flat while financial liabilities decline over time. Many people set their insurance strategy once and they never revisit it. But as obligations shrink and financial independence increases, that potentially lead to overinsuring later years and paying for coverage that may no longer be necessary. An effective insurance strategy should adapt alongside your financial life, just as an effective financial plan shouldn't operate on autopilot. A laddering strategy may provide several potential advantages. It can create more flexibility in a coverage structure, improve alignment with liabilities, and potentially reduce long-term premium costs. It may also help to reduce the risk of maintaining unnecessary coverage later in life while allowing the strategy to evolve alongside changing financial goals. Now, the goal here isn't complexity, it's alignment. So what exactly is laddering? Instead of purchasing one large policy for a single time period, multiple term policies are layered together with different durations. So in the example below, a $500,000 of coverage lasts for 10 years, another $500,000 lasts for 20 years, and $1 million lasts for 30 years. This creates higher protection during peak responsibility years, when income replacement, childcare costs, mortgage obligations, and college funding are most significant. Then, as those obligations decline, portions of the coverage naturally phase out over time. You're essentially matching the coverage duration to the lifespan of specific financial obligations. This chart illustrates the broader financial planning concept behind laddering. Ideally, over time, your family becomes less dependent on insurance and more dependent on accumulated assets. Debt is reduced, investments accumulate, retirement savings grow, and financial independence strengthens. Families may become less dependent on large amounts of income replacement protection through insurance. The goal is not simply buying insurance, it's aligning protection with actual financial exposure throughout different stages of life. Let's look at a simplified example. Here we have the Anderson family. They're in their mid-30s with 2 young children, a new mortgage, and a household income of $250,000 per year. This is a stage of life that many families can relate to. Based on their current responsibilities, each parent has an estimated insurable need of approximately $2 million. Today, they clearly require significant protection, but they also expect many of those obligations to decline substantially over the next 30 years. Here's how a traditional approach compares to a ladder strategy in relation to the Andersons family's insurance needs. The value in this example are based on a 33-year-old female at a preferred health rating. Now, under a traditional structure, each parent purchases a single $2 million 30-year term policy with an estimated annual premium of $1,500 per year. Over the course of 30 years, the total premium cost would be approximately $45,000. Now, compared to the ladder strategy, instead, the family layers a $1 million $30 term with a $500,000 20-year term and a $500,000 10-year term. And you will see over time, their insurance premium costs are reduced as the 10-year and the 20-year policies conclude. During the years they need the protection most, they still maintain the full $2 million of coverage. However, as financial obligations decline, portions of the coverage naturally expire. Over the full 30-year period, their estimated total premium cost is $29,500. And that's a savings of over $15,000 compared to the traditional approach. The other advantage to structuring their insurance protection in this way is that as the Andersons get closer to retirement and their premium costs are reduced, it allows them to ramp up their retirement savings with the money saved on premium in the later years. The goal isn't simply to spend less money on insurance. The goal is to avoid overpaying for coverage longer than it may be actually needed. Let's look at how the ladder strategy matches the Andersons' financial milestones. By year 10, the children are older, college savings are more established, and the retirement savings have additional time to grow. By year 20, the mortgage loan balance is significantly reduced and the major education expenses are complete. By year 30, retirement assets have been accumulated, their mortgage is fully paid off, and the overall insurance need is reassessed entirely with a focus on legacy planning or the potential risk of long-term care. Ideally, this is what financial progress looks like: less debt, more assets, and greater flexibility in the future. Now, many people review their investments and retirement plans regularly, but rarely revisit their life insurance strategy. A periodic review can help ensure your coverage continues to match the life you're actually living today. So my question to you is, does your current coverage still match your life? I'd like to thank you for taking the time to review this presentation. If you'd like to discuss whether your current life insurance strategy still aligns with your financial plan, I'd be happy to help. I invite you to call or email to explore your options and hope you have a wonderful day.